All right, let's dive in. Today, we're going to crack open the books on a company called CDW Corporation. You know, you hear a lot of noise out there, so we're going to cut right through it, get straight to the numbers, and figure out what the real story is with this tech giant.
So let's just start with a big one. $17.31 billion. That's the market cap. So right off the bat, you know we're talking about a serious player here. But, you know, a big number like that, it's just a number, right? It doesn't really tell you what's going on.
So that's the real question, isn't it? What's the actual story behind that stock ticker? Is this company healthy? Is it growing? Is it, a good deal for someone looking to invest? To figure that out, we've got to dig a lot deeper than just that one big number. We need to look at the evidence.
Okay, so the first place we got to look is performance. I mean, at the end of the day, that's what investors care about, right? How has the stock actually done? And with CDW, this is where things get really interesting. It's almost like a tale of two completely different timelines.
And whoa, okay. If you look at the recent trend, it's not pretty. Over the last year, if you were an investor, you'd be down 13.5%. Stretch that out to 3 years, you're down over 15%. And 5 years, down 21%. I mean, if you only saw these numbers, you'd probably think, yikes, something is seriously wrong here.
But, and this is a big but, that's exactly where the story takes a turn. That short-term view looks pretty grim, I'll give you that. So what happens if we stop squinting and zoom way, way out?
Yeah, this happens.
Over the last decade, CDW delivered a staggering, almost 280% total return. I mean, that's just huge. And right there, that's the conflict at the heart of this whole thing, right? You've got this short-term pain set against this massive long-term gain. So that really brings us to the key question we need to answer. Is this recent dip a massive red flag, a warning sign of deeper problems, or is it just a temporary blip for a company that's proven it can win in the long run? To get an answer, we can't just stare at the stock price. We've got to pop the hood and check the health of the business itself. All right, so let's do that health check. We're going to look right past all the market chatter and get to the core engine of the company. How profitable is it, and how strong are its finances? And a really great tool for this is something called return on equity, or ROE. The easiest way to think about it is like a report card for the management team. For every single dollar that shareholders have put into the company, how much profit is the company actually spitting out? And yeah, the higher the number, the better.
And CDW's number is, wow, it's kind of incredible actually. An ROE of almost 41%. Just to give you some context here, a lot of investors would be thrilled with anything over 15%. This is nearly 3 times that. That screams highly profitable and efficient business.
Okay, but hold on. There's always a but, right? There's some important nuance here. How in the world does a company get a return that high? Well, a big part of the answer is leverage. Its debt-to-equity ratio is 2.16. What that means in plain English is that it's using a good chunk of debt to fuel its operations. So this amazing profitability, it's being amplified by borrowed money. Now that's a really powerful strategy, for sure, but you got to know it also adds a layer of risk.
You know, there's a saying that profitability is the ultimate measure of a company's success. It's the engine that powers everything else. And looking at these numbers, CDW's engine, which is fueled by both its own efficiency and that leverage we just talked about, is definitely running hot.
Okay, so we've established the business is making good money. But here's the next question. Does it actually share the wealth with its owners, the shareholders? Let's talk about that direct reward. Let's talk about dividends. So CDW pays out about 31% of its profits in the form of dividends. Now, why is that number important? Well, it shows a really nice balance. They're giving a good chunk of cash back to shareholders, but they're also keeping almost 70% of the profits to pour back into the business to grow it even more. That feels sustainable. It feels healthy. But you know what's even more impressive than just that ratio? It's the consistency. CDW has increased its dividend not just for 1 year or 2, but for 12 consecutive years. I mean, think about that. That kind of track record shows a serious long-term commitment to taking care of the people who own the stock. All right, so let's recap where we are. We've got this weird, conflicting performance story. We've got a super profitable business, and we've got a company that consistently pays its shareholders more and more. Let's pull all of that together for the big final question. Is the price right? Is the stock a good deal today? And to help us figure that out, we're going to use a classic tool, the price-to-earnings ratio, or PE. Just think of it like a price tag. It tells you how much you have to pay for $1 of the company's profit. And just like shopping, a lower price tag can mean you're getting a better deal. Now this is where it gets compelling. Right now, CDW's PE ratio is about 16.75, but if you look at its average over the last 3 years, that was 21.54. So it's currently trading at a more than 22% discount to its own recent history. What that tells you is, compared to itself, the stock looks cheaper right now than it has been.
And here it is, the final piece of our puzzle. The stock's last price was $135.32, but when analysts run the numbers on what it should be worth based on its future profits, they get a fair value of over $160. That difference, that gap, that's a potential margin of safety of almost 16%.
So let's just quickly run through the story the data just told us. 1. Yeah, recent performance has been pretty weak. 2. But the 10-year record is absolutely outstanding. 3. The business itself is incredibly profitable, even if it uses debt to get there. 4. It has a rock-solid history of rewarding its shareholders year after year. And 5. Right now, the price tag seems to be on sale compared to both its own history and what analysts think it's truly worth.
Which brings us to one last big question. When you see all of that together, great long-term performance, high profitability, shareholder rewards, and you combine it with a recent price dip and a lower valuation, what are you really looking at? Is it a warning sign, or is it a long-term winner that's just on a short-term sale? The data gives us all the clues, but that final call, well, that's the one you have to make for yourself.